recipes for technical trading success in Cook's Kitchen.
How soon will the S&P 500 bust through 4,000? Well, if you saw the note from JP Morgan last week on the vaccine news, they're calling for 4,500 now as their year-end target for 2021. Pretty bold call, but we're going to look at the growth drivers and metrics behind a call like that because Goldman Sachs just issued a similar call. And so we want to find out, how are they doing the math here to get us to S&P 4,500 and higher into 2022? Let's step back a moment and take a look at what I was thinking after the election, that we'd fall back. Here was a chart I made after the close on November 10th. Hey, we gapped up, bottom on the election, and we gap up into it. And then this is the spike on the Pfizer vaccine news, November 9th, which was rejected in the S&P, strongly rejected in the NASDAQ, as you can see here. And I thought, hey, we're going to head lower, at least down to these supports, the first green zone. 200-point drop, 6-7% pullback. I thought was very likely. And we're not getting it. Both indexes are finding support, possibly based on, an election, a divided Congress, vaccine. Now we got Moderna vaccine. So let's go over why I still think we're going to pull back again here in November. We're going to look at this. This is the BOFA Global Fund Manager Survey. They do once a month. Tons of good data in there. We're gonna go into that too. But this morning I sold a position ahead of earnings. I sold keys, and because I'm raising cash, I'm over 30% cash, and I'm short-term cautious. Sentiment is overly bullish by almost all measures. We're going to look at some of those, including in the BOFA survey. And lots of catalysts are already here. Good economic data, a settled election, basically, divided Congress, amazing vaccine efficacy from Pfizer and Moderna. And then this rotation where, the S&P is making new highs, but the NASDAQ isn't. That's not the recipe for sustained market leadership. So I say breadth is good, but it's time for a breather. And then we're getting a pendulum swing of COVID infections, as we head into colder months here with no federal stimulus plan, in sight, basically in limbo. And by the way, an hour after I wrote this, I found out my kid's high school is going to be closing to in-person classes in Wisconsin, which is not that surprising. So let's take a look at the Goldman call. This is from Business Insider. S&P will surge another 20% by the end of 2021. Basically, Goldman has a similar target, 43 to 4,500 on the S&P. And this is based on, what are the growth drivers here? Well, they think U.S. GDP growth is really going to snap back and hit 5.3% in 2021, which they think is, it's above consensus. So they're big bulls there. You can see, they have similar targets to JP Morgan, 4,300 by the end of 2021, 4,600 in 2022. A little more cautious, actually. JP Morgan thinks we get there faster. So in breaking down the Goldman call, I can tell you some of the details I got elsewhere in actually looking at their strategy note. They're calling for 175 EPS in 2021, and 195 EPS in 2022 on the S&P 500. Now, if you break that down versus their targets of 4,300 and 4,600, you're talking about a forward multiple of 24 times. That's an expensive market, but that's what bull markets do when they're not done. And some people would argue that a new bull market started in 2020. So maybe this is still the beginning of the surge rather than the end of a 12-year bull market. So those are some things to keep in mind there, how they're doing the math there. Again, and Goldman Sachs noted, they're sort of betting on a divided Congress. that the GOP will retain control of the Senate, and that kind of classic gridlock story. But they also think that the vaccine is more important than the president. All right, so now let's look at some sentiment indicators that keep me short-term cautious, though. So let's go to our classic sentiment indicator, the Investors Intelligence Sentiment Survey, which is basically the newsletter writers. I love this one because they have so much data going back to 1987. What's difficult when you look at it this way from Yardeni is that it's all, all all 35 years are crammed together, so you can see patterns and trends, but it's harder to. So I'll just focus your attention on the middle chart here, the percentage of bulls and bears. 60% bulls, roughly right now, 20% bears. Notice that into the election that dipped. This survey is usually done on a Tuesday, so the new one will likely be published by tomorrow, November 19th, and we'll see where they're at. What I like is when things get really extended, these jaws tend to close back. I call these the jaws here. What you can't see, though, is that since everything's so crammed together, is that if we could spread out these years more, that the market will spend a long time being extra bullish before a correction. So this is sort of deceiving here. This, we're marking the 10th of November data, but you've got basically a whole year crammed in here, or half a year anyway, since the March lows, of just jostling around here at the highs. And so, that's what tends to happen is before you get any kind of significant correction, you get, lots, everybody gets in, right? you pull in all the late bulls finally, and big institutions aren't in a hurry to sell because they're usually well hedged. They're able to buy puts, and unload stock that way too. All right, so let's take a look at the price chart here real quick. So one thing to note on the S&P 500 is that it is approaching 6% above its 50-day moving average. 50-day moving average here, the blue line. This rarely happens, or when it does, it's usually cause for concern. S&P 6% above its 50-day. And the 50-day looked like it was going to roll over here. That's why I was ready to sell this the spike last week and look for a pullback into, 3,300 or at least 3,400, give me 6-7%, if not 10%. And, it's just not doing it. But it is getting extended. If we look at the NASDAQ real quick, not so extended and not so much the leadership. So that's your rotation out of growth into value. But, easily come back to the 50-day again, and you've got this strong support here, as I showed you down here in these charts. This is the first green box is where I'm an initial strong buyer, and the lower green boxes, 3,200 to 3,250 in the S&P, just below 11,000 to 10.5 on the NASDAQ. I'd be a big buyer there into next year. Okay, so let's look at this BOFA survey and see, get some of the details there. They do this fund manager survey just to find out what's the exposure. And what they're finding is fund managers are almost all in. Cash is at record lows, and you can see here, FMS cash levels sink to 4.1% from 4.4%, now below the pre-COVID-19 level, which was 4.2% in January. Vaccine bulls, but COVID remains the tail risk for the market. Macro bulls, global growth and profit optimism at a 20-year high. So risk is on. There is some rotation, but here's another survey I want to show you. This is the National Association of Active Investment Managers. This is these aren't even institutional investors. These are small portfolio managers, RIAs, who probably average less than 50 million assets under management. So they're kind of, it's real money. And the guys and gals who submit to the survey obviously have strong opinions, but they tend to be contrarian too because they tend to get all in at the highs and panic, or are turn a little bit bearish at the lows. So here you see, they tend to spike to 100% equity allocation, and then during September, they got stuck down here at 60% allocation as the market ramped. They also you can break it down by date. So again, this the last survey date we have here is November 11th. We're going to get fresh data probably by tomorrow, but you can see the big swings here. They were down to 70% bullish last week, right into the election, and then zoom back to 96% bullish. So that's another one that's it's not super frothy, but there it is. I mean, look at, they were 103% in the middle of October. All right. Oh, another piece from the BOFA Fund Manager Survey. Here's another way of looking at hedge funds all in, so to speak, and low on cash. AA stands for asset allocation. Talk about overweight equities. This level up here is the highest that they've seen in their data since January of 2018. So all the way back into here, this is the highest we've seen. So this tells you that fund managers are almost all in. And usually when that happens, there's not going to be a panic, but there could be a decent pullback here. I think the market goes to S&P 4,500 in the next 12 to 18 months too. The beauty of that, though, when you look at the growth drivers, GDP, I mean, GDP, this is the thing. We're going to get this snapback where it will seem like the economy is firing on all cylinders. And that's going to keep fund managers piling into equities. So the beauty of this is that if you believe in this theme, then you can invest and trade around it. And, obviously buy the dips, make yourself a wish list of stuff you want to buy. Here was my Q3 wish list, and you can just go on Zacks and create a portfolio to track, and you can get all this data. You can get, growth, price, momentum, performance data. You can get a daily update emailed to you. Here was my top 10 list coming into Q3, and the only one we picked up was Shopify. Missed Square. I missed the trade desk. That's how quick you had to be on that October dip. All right, so make your shopping list, buy the pullbacks in December and or January, and let's trade them well in 2021. Talk to you soon.